Hi everyone, Ken Tumolo with Tumolo Financial. Welcome to this month's Tumolo Talk. Uh, so this month's topic, it's going to be on structured notes, and you might be like, "Oh, what's that?" It's just another investment out there that is gaining popularity, meaning more and more people are starting to know about them. And when we're building portfolios for people like you. A lot of times it really comes down to does it solve something for you? And so these might not be appropriate for everyone. It might not fix something in your picture. And then those of you, it might actually help in your picture. So I'm going to touch on two today. So let me just share my screen. And I'm going to keep this really basic. So structured notes, there's many types out there. Some are just a little bit more complicated to understand than others. So what I did was I went ahead and just picked two of the easier ones to talk about because I'm of the opinion that when you're doing retirement planning, it's better just to keep things easy. And what I mean by easy is use the investments that a lot of times are easy to understand, not the complicated stuff. So structured notes, what they are typically is they're notes put out by a bank usually. And what the bank does is they set certain parameters on them. So the two ones that I'm going to talk about, again, principal protection, dual directional. I'll start with protection. Example. Easiest way for me to explain it is give you an example. So let's say JP Morgan puts out one of these notes. Typically, these principal protection notes are 15-month terms. So we know there's a term period. Think CD. When you go to buy a CD at the bank, there's usually a term, and you're in it for that amount of time. So shorter term, 15 months. And what you do, let's say I go down and I want a structured note, a principal protection note from JP Morgan, and they're offering one. And I want to put, let's just say $20,000 into it. What I'm doing is I'm buying into it with $20,000, and what they're promising me is they'll set a rate that it actually can gain up to. And it's based on indexes within the market. And usually they pick one, two, three different indexes, and then they tell you which one they'll follow, or they'll follow three and then say, okay, well, you're going to earn based on the lowest return on all of them. It could be, oh, well, you're going to earn on the S&P. But they set this cap rate. So for an example, let's say they were to set a cap rate of 12%. So what they'll do is they'll look over that 15-month period, and if the market goes up and they're looking at the S&P 500 for an example, then my money would gain, if it market went 12% based on that index, I would gain 12% when it finishes. Now, let's say the market does the other thing and it goes down, and let's say the market went down 1% or 10% or 20%. The reason they call it principal protection is whatever you put into it. So if I put $20,000 into it and the market went down and then I reached end of my term, then I end up receiving all my money back, but I don't get any interest. So best way to explain it's giving you a chance to earn something based on the market without the downside risk. Now, risk isn't an important thing to understand. There are risks in the notes. For an example, if I went and I bought this note and it was a JP Morgan note and JP Morgan went out of business, then I'd lose my money. So when you're evaluating these and looking at using these notes, because there's so many of them out there and different companies put them out, you want to do the research on the company that's also offering it. So I always am of the opinion, well, if we're going to use these, then we want to use someone big that has good financials. And maybe it is JP Morgan. And you look at their financials and decide whether or not you trust a JP Morgan and that they're in good financial shape. Second one I'll explain is the dual directional. And you're like, okay, well, now this is starting to sound a little confusing, but it's not. It's actually pretty easy. This one, I'll explain it quickly. What they do is same thing. You give a JP Morgan, let's say you buy a JP Morgan note or a Bank of America note. You put $20,000 into it. You can put different amounts into it. I'm just using 20,000 as an example. But let's say the market goes up, there's usually a cap on the upside. So let's say that was 10%, then it'll allow it to grow up to 10%. And by the way, Dual directional notes are usually written in 12-month or 24-month time periods. So you can go even shorter with these dual directionals. So we've got the upside of it. On the downside, and this is where it's a little bit different, for every percent down to 20%, and they call it a buffer, you gain a percent. So let's say your term ended and the stock market was down 10%, whatever index it's following, you actually gain 10%. If the market went down 20%, you gain 20%. But if the market went down more than that, there's that 20% buffer, you start to lose money. So if the market went down, for an example, 25%, you actually lose 5%. So you don't lose the first 20%, you lose only the 5% after the 20. So another tool out there that can be used in retirement planning on the investment side of it are these structured notes. One thing I will caution is don't go running into these things. Meet with someone, talk about them, and then what you want to do is usually a risk assessment, and then whether or not this is something appropriate to help you in your picture. So just another investment that's gaining ground out there that more and more people are becoming aware of. Again, how can we help? Just give us a call, 860-650-3005. If you want more information on structured notes and you're just interested in them, feel free just to call us up and we'll talk to you. But before we were to actually use it in your situation, we would actually have to do an evaluation. If you're a current client, yes, we do have a lot of information on you, and including projections and your financial situation. But we always like to talk it through before we do anything differently. Thanks again for watching this month's Tumolo Talk.